In this video, I want to talk to you about a pricing strategy called target costing. In relative terms, it's a new kid in the block, first introduced in the 1960s by Toyota. In this video, I'm going to compare and contrast cost-based pricing with target costing. I'm going to go through the benefits of target costing as well as its limitations, and we're going to go through the 5-step process that's required to implement target costing. Hi folks, welcome to another weekly episode on I Hate Numbers, the channel that's there to increase your financial awareness, make you more money motivated, improve your money mindset, make profit, save tax and time. What's not to love about that? Let's crack on with the video. The traditional route for costing is what's called cost plus pricing. And for the sake of visuals, I'm just going to introduce a table here to compare the differences between the two concepts. Under traditional cost-based pricing, a product provider would first of all work out what the costs of productions are now and going forward, typically taking into account direct costs, so materials and labour costs, all the support costs and overhead costs of the total production run, work out the unit cost and then add a required profit margin to that. That would then represent the base point for the price to the customer. What that means is that the costs influence the price. It's a relatively simple methodology to apply, and it's been with us for quite a number of decades. It does, however, have inefficiencies in the sense that once we have that pricing strategy, we may find that customers are really quite indifferent and not really that bothered about what our costs are. They're more concerned with not only the value that we're delivering, but the price we're charging. That may build in inefficiencies, and we don't create a cost culture where we're challenging costs and trying to minimise the inefficiencies that arise. It also requires us to obviously have some understanding of our cost base, what our overheads are, what our direct costs are. But the methodology has been ingrained for quite a number of companies, and it's well rehearsed and it's known for its simplicity. Little data is required, and later on we can make adjustments to the price as compared to something called target costing. Now, market-based prices are driven by the idea that pricing is based on what the customer is prepared to pay for a product or service that we're providing to them with the defined attributes of that product. So it's more market-based, it's more customer-orientated, and again, that takes into account that customers are indifferent and not that concerned what it costs us to provide our product to them. With a market-based, more specifically target costing approach, pricing creates that environment where we challenge costs at the very outset. It's certainly more involved, certainly more data is required, more understanding of the marketplace, more understanding of your customers' requirements is required, and it adopts a technique called reverse engineering. What we're doing now, we're working backwards from the price to determine the target cost itself. More of that later on in this video. It means we're also much closer to the customer, and we're pricing based on customer requirements and customer expectations and what the customer is prepared to pay, as opposed to us imposing a price on that customer, which might make us uneconomic and make us very uncompetitive at the same time. Now let me explore more so what target costing actually is. Now, target costing, as I mentioned at the beginning of the video, was developed in the 1960s by market and cost researchers working for Toyota. It's still very widely practiced and is mostly closely associated with Japan, which has introduced quite a number of managerial concepts on costing and pricing and strategy into the modern world. Many of Japan's leading manufacturers such as Nissan, Toshiba and Toyota are known for their devotion to target costing. Well, what does that actually involve? Now, the idea is that once we design a product, once we come up with a product here, most of the costs are locked in at that design phase. And therefore, getting those efficiencies, getting us to drive down costs, it becomes much more difficult once we've actually gone forward here. It creates very much a managing cost environment. It's all done and executed at the planning stages. So before we commit resources to doing something, we have an idea and an expectation what the target costs must be in order to meet our desired price and our desired profit margin. So effectively that culture of cost management is not after the effect, but it's actually done at the earlier stage. Now here's the typical stages involved in target cost. Now, before we explore these stages in more detail, it's worthwhile summarising that even though it requires lots more data, traditional costing has a tendency to underestimate costs and overestimate the profits, leading to wasteful spending and also producing products that are largely unprofitable. It's also criticised for its inefficiencies, and as we said earlier on, it creates that environment where our companies, our managers, our workers do not necessarily get a cost culture where costs are being challenged. Now, target costing is a modern technique of cost control, and it's reverse costing technique in which we first of all determine the selling price. So stage one, by the power of magic, here we go. Let's go forward. Stage one, there we go. So first of all, what we need to do, based on the product we're providing, whether it's an MVP, minimum viable proposition, the product we have, we typically ask our clusters, our target customers, what price they're prepared to pay for a product that we're going to provide with certain attributes. So we set the target price initially. Notice the cost isn't determined at this stage, merely the target price. What's the price in which this product can be sold? Now, initially, target costing evolved in the product environment, in the manufacturing environment, but there's no reason why we can't adapt it to a service-based environment as well. Once we've determined that, we need to have some idea is what our required profit margin is. Typically, if we're selling a product for 25, that's the target price our customers are prepared to pay. We might say that we want to make effectively either a 20% return on that, which gives us a target currency figure of 5. The product's going to be sold for 25. Our desired profit margin is 5. What this means as business owners, we have to have some idea is what is it we would require, what is our expected return on making something. It's not a question of flipping a coin and hoping for the best. Some expectations need to be established at the start point. Once we know what our target price is, in this example we said $25, we've set our target profit, which may be $5, then the target cost is 20. Now what we need to do also though is to calculate based on existing situations what the actual cost will be. And what is likely to happen is we'll have a cost gap. Once we know what the cost gap are, we can reverse engineer, see if there's anything we can do in the manufacture of the product or the design to eliminate non-value added components. Are there any elements of the product or the service that we're delivering that we can eliminate without impacting on the customer experience? Are there any things that we can do in the way the service is provided to make it more efficient and to drive down the cost so we meet our target cost? And that, folks, is largely the approaches that we do in target costing. If you want to learn more about this, there's a link in the notes at the end to a more detailed blog on this. I hope you found this video useful. I'd love it if you could share it within your own network. Give me any feedback and comments that you've got. And until we meet again next week, have a great week, folks.